So it says something on incomplete records. Incomplete records.
Okay.
So incomplete records.
Yes.
So we say it arises where? It arises when a firm does not maintain, when a firm does not maintain proper books of records. It arises when the firm does not maintain proper books of records. So the information about the firm is incomplete, but has balances of assets and liabilities. But has balances of assets and liabilities. Together with the summary of transactions for the year. Together with summary of transactions for the year, as revealed by the bank statement. As revealed by the bank statement. Remember, for advanced tax tulisema si ni KRA. So we encounter
Yes.
these firms which do not have an accountant. These small firms. So they don't have anything to do. They don't have an income statement. They don't have books of accounts. But when you look at them, they'll always tell you our assets are these and these and these. Our liabilities are these. Huu mwaka tulifungua na debtors of this much na tumefunga na debtors of this much. Then you also have at least we can have, hata kama hawana bank statement, zile transactions wamemake, they can summarize the transaction. So this is one way of recovering some taxes from those small traders who do not maintain books of accounts. So next point, two key accounts.
Hello.
Yes.
Someone tried to call me.
Sorry.
Okay, can continue.
So we are saying that for the incomplete records, you look at the small traders who do not maintain proper books of accounts, hawana P&L, they don't have anything. But they can tell you these are our assets and these are liabilities at the beginning and at the end. And these are bank statements.
Yes.
These are the transactions for the year. So from that information that is incomplete, prepare the books that should give you the tax to pay for the year. So the records are incomplete. So you're saying that two key accounts are involved. Two key accounts are involved, i.e. number A, debtors control account. Debtors control account. So you have the debtors control account there. Then you can say it helps to determine amount of credit sales. Amount of credit sales. So how much were our sales on credit? Debtors control account helps determine that amount of credit sales. So let's see, it's a T account. So you have debtors control account. Let's prepare it here. So here we have shillings. So as far as this account is concerned, so we have this is an asset account. So you have the open balance brought down. Balance brought down, you have it there. I think I should bring this one huku nje. So you have the balance brought down. These are the side. So the transactions that affected us during the year. We're expecting some receipts from our customers. So when we're expecting some receipts, we debit the bank, we credit this amount. So receipts from customers. Customers wametulipa pesa ngapi? So you have them there. Other thing that will affect us, we have so these are receipts from customers. Let me do this. You also have from the sales point of view, we have the discount allowed. When you allow the discount, so discount allowed, we have it there. What else can we have under this? We can have return inwards. Tulikuwa tumeuza, wanaturudishia return inwards. We have when we had some credit notes. So you have the credit notes. Credit notes affects when we sell the credit notes. Credit notes are meant to correct an overpayment. Debit notes are meant to correct an underpayment. They can have credit notes issued. Credit notes issued. Kama tuko na on this other side, of course, if we have the credit notes are meant to explain that tukikuuzia tulikuwa overcharge.
Yeah.
Tukikuuzia tulikuwa overcharge. Huku ndo kule tumeuza, huku ndo kule tunalipwa. When you are selling to you overcharged you, so we need to refund you. So we reduce ourselves by giving you a credit note. If we undercharged you, then we shall issue with a debit note. Debit notes issued. Debit notes issued. And of course, the balancing figure, kama tuko na dishonored checks, customers walikuwa wametupea checks, dishonored checks zinakuja huku. If we have any dishonored checks, inamaanisha wakati walitupea checks tuliweka hapa, zimebounce, we just reduce what we expected to receive. And of course now the balance, we have the closing balance, so the balance carried down. balance carried down, and the closing balance becomes credit sales. Credit sales. So credit sales is the balancing figure. I'm not sure kama tulikuwa tumemention vitu kama had we done anything of this nature?
No.
So this is our debtors control account. It's just meant to help us get it's just meant to help us get the amount of credit sales the way we've gotten it by balancing the ledger. And of course it will balance off. Then hapo chini tuna appreciate kuwa total sales would be equals to cash plus credit sales. Cash plus credit sales.
That is cash sales.
Yeah, cash sales plus credit sales. So credit sales tumezipata hapa. Kama kuna any cash sales, tunaziongeza to get our total sales. So tulisema there are two key accounts that are involved. Account number B, we have creditors control account. But if we have bad debts, you can also add here bad debts. Sorry for that. Hapa tunaweza ongeza bad debts. Bad debts written off. If we have bad debts written off, they also reduce our sales.
Okay.
Yeah, but not provision for bad debts. It must be bad debts written off. Provisions don't appear in the control accounts. So I have creditors control account. So debtors control account helps us to get credit sales. Creditors control account, it helps to get the amount, to determine amount of credit purchases. It helps determine amount of credit purchases. So let's prepare the account again. So the creditors control account. So this is a liability account. This is a liability account. So being a liability account, opening balance ni credit side. So you have the balance brought down. Let me do this. So balance brought down is a credit balance. This account will be reduced by payments. Payments to suppliers. So how much did we pay our suppliers? We pay them that much. It will also be reduced by return outwards. Return outwards. If there is any discount that we received, Discount received kama tuko nayo. So just the opposite of debtors control account. Hapa tuko na return inwards. Inwards kwa sababu tulikuwa tumeuza zimerudi in. Outwards kwa sababu tulikuwa tumenunua tunazirudisha out kwa suppliers wetu. We receive discount from our suppliers and we issue discount to our customers. Then of course we have, if we have any credit notes, sasa hapa ni credit notes received. Credit notes received. Anything issued affects sales. Anything received affects payments. So we receive from our suppliers, but we issue to customers. That's why these are credit notes issued, and these are debit notes issued. So credit notes are meant to correct an overcharge. Debit notes are meant to correct an undercharge. So it all depends. Are we issuing or are we receiving?
Okay.
If you are issuing, it's affecting our sales. If you are receiving, it's affecting our purchases. Debtors control account is an account for sales. Creditors control account is an account for purchases. Hope that is clear.
Yes, it is.
Great. Hi. So of course, if we have credit notes issued reducing our purchases, then of course debit notes issued debit notes received, sorry. Debit notes received will affect our purchases, will increase our purchases. And of course, at the end of the day, we have balance carried down. Balance carried down. And the balancing figure becomes credit purchases. Which is our balancing figure. And of course, our total purchases, just as the total sales, total purchases becomes cash plus credit purchases, because cash is cash purchases. Cash purchases plus credit purchases. Those are the two key accounts that are involved in incomplete records. After having the two accounts, ukimanage hizo two accounts, hizo swali linakuanga ni kama limekwisha. But on top of that, we also need to appreciate that after getting our sales and getting our purchases, we need to get the cost of sales. Cost of sales, which equals to opening stock. Opening stock, we add purchases and we less closing stock. That's very key. Hizo tu. So I think we can.
That's nice.
Yeah. So can we have this question now? There is April 2024, question 1B. Somebody's asking you that Speedtech Corporation is a multinational technology company operating in Kenya. The company provides digital services to consumers in the country Analyze the impact of digital service tax on Speedcom Corporation operations in Kenya. So how can tax affect the operations of a company in Kenya? So analyze the impact of digital service tax on Speedtech Corporation operations in Kenya. Even if you don't know what we mean by the digital service tax, it's a type of tax.
Yeah.
So how does taxation affect the operations of a company in Kenya? Hizo ndo points ziko hapo za kujibu.
Okay.
So effects of digital service tax on companies. It increases the operating costs. That's the key. That's the key impact of any type of tax to Kenya. So after increasing the operating costs, of course, if the costs are increased, the chances of expansion will also mean it will be reduced. So it reduces the rate of growth. It reduces the rate of growth. In the digital industry. Then there's another impact is about the capital allowances that we get. It's not all about hiyo tax inawaumiza. Courtesy of the capital, the depreciation. There's a way the investments in the digital, in the satellites and what have you, are always associated. They attract capital allowances. Capital allowance the depreciation. So you can just say another impact: capital allowances associated with digital industry. Capital allowances associated with the digital industry increases allowable expenses. Increases allowable expenses for tax purposes. That's very important. And maybe we can talk about due to high taxation. Another point, due to high taxation, it may increase cases of tax evasion. Due to high taxation, it may increase cases of tax evasion. Now, part B is our concern. The following information was extracted from the books. The following information was extracted from the books of Henry and Titus, who operate a partnership business and share profits and losses in the ratio of 3:2 respectively. So this is a partnership. An extract from the statement of financial position. 31st December 2020 revealed the following information about the partnership. You can have freehold land, office equipment, furniture and fittings, delivery vans. The net book value as at 31st December 2022 was the same as the tax written down values. So they'll attract the capital allowances, no problem. Current assets and liabilities as at 31st December 2022 were reported as follows. So 31st December 2022, tuko na stock, debtors, bank overdraft, cash in hand. On 1st January 2023, each partner contributed additional capital of 5 million. Interest on capital was at the rate of 5% per annum. Sales proceeds that were banked in the year amounted to 160 million. The accountant had paid the following expenses from sales proceeds before banking the balance. So these are the receipts from our customers. So we didn't receive only 160 million. We received this 160 plus all that is here. Because after we received the amount our customers paid us, tulitumia some of the money to pay for these expenses, alafu ile balance ilibaki ndo tukabank. That's why I told the accountant had paid the following expenses from the sales proceeds before banking the balance. So
Okay.
here, in receipts from customers, we shall not put the 160 million alone, but it's 160
We
plus
look
all
at
these. Hiyo kizungu iko sawa?
Kabisa.
From the bank, the partnership made the following payments. Purchase of computers. Computers are fixed assets, zinaenda kwa capital allowances. Purchase of motorcycle for salesmen. Motorcycle are fixed assets. Staff salaries per month. Staff salaries, those are expenses. Purchase of goods for resale. Those are payments that you are making. So when you are making payment for purchases, sinakuja hapa. Nakuja hapa. Now we are here. We are told that we have from the bank, the partnership made the following payments: purchase of computers. Computers tumesema zinaenda capital allowances, those are fixed assets you are buying. Motorcycles, salaries, purchase of goods for resale. Remember, when we are making the payments, the partnership made the following payments. So that means tunakuja hapa. Those are the payments to suppliers. It affects our creditors control account. Drawings per month, cash drawings from the bank. Henry, Titus, and Stella will withdraw some goods. We have the bank charges. Bank charges are expenses. Telephone bills per month, those are expenses. Electricity bills, those are expenses. On 1st September 2020.
So will you?
Yes?
It's easy for per month. Will you multiply by 12?
Yes.
Okay.
If we need for the whole year, we shall multiply by 12. Then on 1st September 2023, Stella was admitted as a partner on the following terms. So circumstances under which a partnership comes to an end: when a new partner joins, when one partner retires, when you decide to change it into a company. So hapa tuko na biashara mbili. Stella came in, that means we have a partnership business that ran from January to August, and we have another one that ran from September to December. So she was to contribute a capital of 16 million. She was to receive a salary of 80,000 per annum and commission of 1% on the total sales made after her admission. Interest on capital was to be charged at 10% per annum from 1st September 2023. Profit and loss sharing ratio was changed to 3:1 for Henry, Titus, and Stella respectively. Analysis of other records reveals stock as at 1st December, that's the closing stock, 6.4 million. Sorry. Then we have included in the stock at year end were goods which had cost 880 but could now be sold for 640. So stock is always valued at the lower of cost and net realizable value. Stock is always valued at the lower of cost and net realizable value. So out of this 6.4 million, kuna 880 ambayo can only realize 640. So tunafaa tutoe hiyo difference hapa ndani. So this stock is overstated. You see that?
Yes.
Yeah, so ni kizungu mingi tu examiner hutumia kutuchanganya, but you just need to be keen on details. Then we handle it case by case. Trade payables and trade receivables as at 1st December 2023 was 1280 and 1120 respectively. Discount received from suppliers amounted to 576,000 for the year. That is discount received. Sales, purchases, and expenses accrued evenly throughout the year. Partners' capital as at 1st January 2023 was contributed equally by Henry and Titus. Assume a 52 weeks year. So prepare a statement showing the taxable profit or loss of the partnership before and after admission of Stella for the year 2023. Good. So wanaitwa Stella, Henry, Titus, and Stella. Let's answer it and see. Henry.
The first one will be Henry and Titus.
We kill two birds with one stone.
Okay.
So Henry, Titus, and Stella, 2023 taxable income computation. So hapa tuko na, I think it's 8 months, January to August. Tuko na 8 months. Alafu tuko na 4 months, September, October, November, December. Great. So 8 months wako na biashara inaendelea na tuko na 4 months. And before we reach here, we need to have our workings, sorry. We need to have our workings. Before tuanzane na kutengeneza income statement, we need our workings first of all.
Okay.
We need to have some workings. Need to have some workings before we start. Tuendelee basi. As our workings, we need to start by we need to know how much is our capital at the beginning of the year. Hapo ndo hiyo something ilifichwa. And we know that capital equals to assets minus liabilities. Capital equals to assets minus liabilities. So that is capital at the beginning of the year. So at the beginning of the year, assets tuko nazo ziko kwa note number 1 na note number 2. Na liabilities pia. So our assets in note number 1, we are having 64,000. Plus 4160 plus 4800 plus 8,000. All those are assets. In note number 2, current assets and liabilities ziko up. We don't have any liability in note number 1. So we have 8,800. We also have receivables of 640. We have cash in hand of 64. And we subtract the bank overdraft, which is a liability of 480. I think that in hizo tuko nazo. So the opening balance of our capital becomes 89,984. Hiyo ndo alisema alishare equally.
Yeah.
Then working number 2, we need to get our debtors control account. Debtors control account. Do you have the opening balance of our debtors? 640. So therefore we have balance brought down, I think 640.
Dongo.
Mm-hmm.
Mm-hmm.
640, right? In note
Yes.
number 2.
No trade receivables.
Yes. Transactions during the year, anything affecting our customers? Note number 4, they paid office rent, office expenses, laptop salaries, carriage outwards, salary to partners. Note number 5, is any payments. I couldn't actually affect customers. We had, she was received, stocks, discount received, on your debt creditors. So you don't have any other thing. Do you have balance carried down? The balance carried down, I can see it in note number 7 huko chini.
Note number 7.
I think 1120.
Receivables 1120.
1120. 1120. Then of course the balancing figure becomes credit sales. So credit sales becomes the balancing figure, this minus that. And you appreciate that total sales would be equals to cash sales plus credit sales. Our cash sales hatujapewa popote, so it is 0 plus 480. So which equals to 480?
Yes.
Great. Then we need another working to have any purchases. So creditors control account. Creditors control account. Do you have the balance brought down for our creditors? Note number 2 is about the trade receivables, bank overdraft. Creditors hakuna, so it is 0.
Kuna payable, yeah.
Hakuna. Then of course, do you have kuna story tulikuwa nayo kwa note number 6, note number 7 actually. Stock, payables and receivables. Do you have discount received?
Yes.
So discount received inakuja hapa. We received a discount of how much? 576.
576.
So it affects our creditors on the debit side. And of course, we have the balance carried down. The closing balance for creditors, is it 1280?
Yes.
1280. And the balancing figure becomes credit purchases, which is the total of this, the balancing figure. So equals to this plus this. That balances off that. So 1856. By the way, we had some payments that we made before that. Tunanyoroshwa. Kulikuwa na payments kwa note number 5. So kwa note number 5 tuko na payments za 124,800. So meaning hapa before this, sorry for that, kuna payments tumemake. Payments that we made to suppliers, I think 124,800. Note number 5.
Purchase of goods.
Yes.
For resale, yeah.
Yeah. The partnership made the following payments. They paid for purchases of goods. So that now our balancing figure, we should also include that. So that should give us our total purchases. Total purchases to be equals to cash plus credit. Cash purchases tumepewa kweli?
I thought hizo ndio tungepick kama cash purchases. Hizo 128. Is it 124,800?
It makes no difference.
Okay.
It makes no difference. You can hata ukiziweka hapa because they are not very clear on whether they are cash or non-cash.
Yeah.
Because again, cash purchases and you are paying through the bank, but it makes no difference as long as they all appear in our books. We are comfortable with it.
Okay.
So therefore, that is our total purchases. Can we have the cost of sales? Opening stock plus purchases minus closing stock. Do you have our stock at the beginning? 8,800, right?
Yes.
Plus purchases of 1266.56 minus closing stock. Closing stock ilikuwa pale chini. The stock note number 7, 6,400.
We want to adjust something.
Yeah.
Hapa nasema could only be sold for 640.
Yes. So 6,400 you should subtract. Actually you can do 6,400 minus tutoe hiyo 880 alafu to add 640. Does that make sense?
Yeah. Yes.
Great. So that becomes our cost of sales. So tukishapata cost of sales, actually we can go an extra mile tupate gross profit. tupate gross profit. And we know that
Okay.
gross profit equals to sales minus cost of sales. Sales minus cost of sales. Do you have our sales? Sales zetu tulikuwa nazo hapa juu kwa
Yes.
debtors 480
Tulikuwa na total sales.
za 480, si ndio?
Yes.
So 480 minus cost of sales of 128, 816. The question looks ambiguous, but now it has been tested. We must answer it. Sales proceeds that were banked. Kuna kitu ya sales tumeiacha. Check note number 4.
So ile 160 plus whatever I did.
That should be our cash sales. Tuitafutie space hata kama ni hapa chini, kama uko juu ushamaliza. Let's just talk about cash sales equals to 160,000 plus, let's put this in brackets. So note number 4, do we do 32 times 12? 32,000 per month.
Yes.
Plus office expenses weekly, that is 8. Walituambia to
So we
assume
should do. We
a week
should
has
do
52.
32. Yeah. Like this.
52, not number 8. Right?
Pardon?
A year has 52 weeks as per note number 8.
Yes.
So ile ya weekly una multiply by 52, ya monthly una multiply by 12. Laptop is one off, so plus 40. Plus 3.6 times 52. Right? Plus 5.2 times 52. Plus 16 times 12. Then plus 24 times 12. That's okay?
Yeah.
So that is our cash sales.
So yes.
So therefore, total sales becomes, yes, our cash sales plus credit sales, which is 1777.6 plus our credit sales of 480. So there we go. So therefore, our gross profit would be equals to sales of 162, 257.6 minus the cost of sales of 128, 816. That is our gross profit. Sasa ukishafika hapo, Hiyo swali umeilegeza sasa. Once ukishang'ang'ana
Okay.
ukapata gross profit, to me I always consider that question is as good as done. Now you can now prepare your accounts well. So for 8 months and for 4 months. Then we can simply start. So let's have it in thousands of shillings. So ni kama tunatengeneza accounts za kampuni mbili.
Yes.
Moja ina run for 6 months, for 8 months, ingine ina run for 4 months. So let's start with gross profit. Gross profit. There are 8 months, you simply apportion accordingly. That's why tuliambiwa it accrued evenly. Ukiangalia hapa, sales, purchases, and expenses accrued evenly throughout the year. So for 8 months equals to 33,441.6 times 8/12. Year 4 months is times 4/12. That's our gross profit. Hakuna income ingine. Then we less.
Gross profit. Oh yeah, I've seen. Umefanya direct.
Yes.
Got it.
Iko sawa.
Kabisa.
So we less allowable expenses. Allowable expenses, tunaweza anza na note number 4. So sales proceeds that were banked in the year, the accountant had paid the following expenses before banking the balance. Office rents ni expense.
Yes.
So have office rent. Put here for 8 months, we put here for 4 months. Can do 32 times 8. Na hii side ingine ni 32 times 4. Je, iko sawa?
Very, very okay.
Office expenses. 8,000 per week. So that is 8 times 52. Then times 8/12. I think that's fine. Because it's weekly.
Yes.
Then on this other side, it's times 4/12. What's not happening? Haya, hiyo tunafaa to reduce. Tutaireduce baadaye. So after the office expenses, laptop for office use. So laptop, we give it the capital allowance. Laptop, did you remember it's class the second part? Office computer software computers ziko hapa 25% on straight line basis, ndio?
Yes.
So laptop for office use, we have 25% of 40. 25% of 40, then you apportion accordingly. So that looks like 10. So equals 2.25 times 40 times 8/12. Then huku ni times 4/12. That's for the laptop, salaries and wages. That's an expense. So salaries, casual workers 36. So 3600, that is 3.6. 3.6 times 52 times 8/12. Hii side ingine ni times 4/12.
Yeah.
Then we have carriage outwards. Carriage outwards, that is an expense. Hiyo ni kama delivery costs. So carriage outwards, that is 52. So equals 5.2 times 52, times 52 times 8/12. Copy. Hii side ingine ni times 4/12. Salary to partners, that is not allowable, right?
Yeah, wrong.
Tuko na computers. So computers, we give them capital allowances, 25%. 25%, we bought computers 104.4, 102.4. So equals 2.25 times 102.4. We apportion accordingly 8/12. So huku kwingine ni 4/12. Right?
Yes.
Motorcycle. Motorcycle 160. Motorcycle is also 25%. Motor vehicles. 25% of 160. So equals to 0.25 times 160 times 8/12. Huku kwingine inakuwa times 4/12.
Yes.
Staff salaries per month. So you have staff salaries. Per month, you simply multiply 80 times 8.
Unit direct.
Yes. Ni hizo English ndio huwa inasumbua watu. Then 80/4. Ukiwa na pressure ndani ya exam, hizi vitu hautaziona. Purchase of goods tusha deal nayo. Drawings of cash. So ingekuwa drawings of goods inge affect the cost of sales. Drawings ni disallowable, tunge less kwa closing stock, because it would mean closing stock is understated. But drawings of cash does not appear in the income statement. We have bank charges per month, 2,400. That is 2.4 times 8. And 2.4/4. Do you have telephone bills?
Yes, of 6.4.
So telephone 6.4 na pia ni monthly.
Yes.
So equals to 6.4 times 8 and 6.4 times 4. Electricity per month, 8,000. So that is 8 times 8. And we have 8 times 4. On 1st September, Stella was admitted. Contributed capital of that shows to receive salary, interest on capital, profit and loss. Number 7, stock included in the bank yield share deal now. Sales, purchases, expenses. So there you go. With that one, share part of the 12 marks. So we have all these expenses.
Okay.
So it's summation of B. B247. So therefore, taxable income, nimekufanyia total, equals to gross profit minus the expenses. Gross profit minus the expenses. And those are our 12 marks. Umeona penye kazi iko? Hapa juu.
Hapo ndio kibarua iko. Tafuta hiyo
Ukishapata,
gross profit.
yes, ukishapata hapa, ukishafika tu kwa gross profit, hii ingine ina flow.
So but hizi entries ukiapportion vizuri still marks.
Yes. But the bigger percentage of marks are concentrated hapa juu. Because as you can see, hapa ndo kuna
Huko kwa
hapa ndo kuna kizungu mingi.
so,
Yeah. So after getting the 12 marks, can we get the 4 marks?
yes.
So you can have the allocation schedule. Did you do a question on allocation schedule, partnership?
I don't think tulifanya hiyo.
So hii ni kama tu ile partnership ya accounts, because we all know that a partnership, the partners are supposed to share the profits from the partnership as per their profits and loss sharing ratio. So that now, instead of taxing the business, we tax the specific partners. So we don't tax the business. A partnership is never taxed. It is the partners that are taxed on income from the partnership. So you can see we're almost being logged out.
Okay.
So tuko na 8 months. Kwa 8 months tuko na partners wawili. Mmoja anajiita Henry, mwingine Titus. So hapa tuko na Henry. So back to what we are saying, that as far as the partnership is concerned, we don't tax the business, we tax the respective partners as per their profits and loss sharing ratio. So we have Henry, we have Titus for the first 8 months, and we shall need their total. Then for the other 4 months, we have Henry, we have Titus, and we have Stella. And we need their total. So we need to condense this. Great. So you have it there. So the figures, of course, are in thousands of shillings. So we start by giving them their salary to partners. So remember we said that I think we did that previously, kusema kuwa there should be no transaction between the business and the partners. That's why salary to partners hatujaweka popote hapa juu, but now this is where they belong.
Okay.
Don't give them anything in the business, but the profit from the business will be allocated to them. So before you allocate this profit to them, first of all, give them their salary, give them their interest on capital, all those that you are putting here. So salary to partners zilikuwa somewhere.
Or note number 4.
Note number 4. Sales proceeds, blah, blah, blah. Salary to
the last one.
Henry, 16,000 per month. Great. So Henry's is 16 times 8 for the 8 months. So 16 by 8.
One to 8.
Then we cook for the 4 months. Henry 16 by 4. Titus is getting 24 per month. So equals 24 by 8. Na huko kwingine ni 24 by 4. Stella was also to enjoy some salary. Note number 6. She was to receive a salary of for 80,000 per annum. So for 80,000 per annum. So Stella equals to for 80 times 4 over 12. Kizungu tu. So for 18 ya 12 months. Hapo Sonne ilikuwa na kunyorosha?
Hapo ningenyorosha.
Kabisa. It's just the tricks, the small tricks ndo kwa zinatusumbua. But once you relax and you interpret, just internalize and interpret the information, you are good to go. So you have the totals here. The total for that. And you have the total for the 3. After salary, were they supposed to enjoy anything else? Interest on capital. Blah, blah, blah. Any information about interest on capital? Note number 6.
Note number 2.
Note number 2.
Number 3.
On 1st January, each partner contributed additional capital of 5 million. Interest on capital was at the rate of 5% per annum. So you have interest.
But this one is in the 2023.
Yes, but you are preparing for, this is 1st January 2023. So ile capital walikuwa nayo, capital at the beginning of the year 2023, tulikuwa tumecalculate. Which is 49 whatever, right?
Yeah.
89 984. So this 89,984, hii 89,984, each partner akaongeza capital ya 5 million. So this one naweza nikaongeza, can I add 5 million times 2? That is our total capital. At least hiyo ilikuwa for Henry and Titus.
Yeah.
Out of these, we can apportion accordingly for 8 months, alafu for 4 months. That is for Henry and Titus. Twende pole pole. Now, kuna 5%. So there for Henry, for the first 8 months, alipata 5%. So equals to 5% of these. Now remember, tunafaa to divide by 2. See capital will contribute by each one of them.
Yes.
Or let me do this. Hapa, for each partner, nichukue this, divide by 2. So hii ni ya Henry na hii ni ya Titus. So the interest on capital for Henry in the first 8 months, it is 5% of these. Right?
Yes.
Titus Titus pia 5% of that. That is for the 8 months. No, this is times 8 over 12, sorry. Times 8 over 12. In 5% per annum.
Yes.
Hii pia ni times 8 over 12. Kizungu tu. Then Henry and Titus, for the other time, pia wako na hii, lakini now it's for the remaining 4 months. So it's still times A, but now times 4 over 12. Hii pia ni 833.2. Sindio? Tuko sawa mpaka hapo?
Yeah.
Haya. Stella naye akaletea ngapi? 16 million.
16.
Na interest on
September.
capital was to be charged at 10% per annum. Let me see. Stella was admitted the following terms. So interest on capital was to be charged at 10% per annum from 1st September. So meaning from 1st September, hata hapa haikuwa 5%, ilibadilika. Sasa ikakuwa 10%. Umeona hiyo?
For each person.
Yes. So now these became 10% for the 4 months. So this one equals to this. So Stella equals to 10% times 4 over 12. Yes. Thank you. Times 16,000. Hizo kizungu mingi tu ndo zinakuanga za kukoroga.
Kidogo na nyoroshwa.
Yes. So you can get the totals here. You can also get the totals here. After interest on capital, did we have, kama tungekuwa na any bonus, tungeiweka, but haiko. Tungekuwa na any commission, tungeiweka. Commission paid to partners, tungeiweka. Na tungekuwa na interest on drawings. Less interest on drawings. So I'm just putting every details that would affect the allocation schedule, but we don't have them. So because we don't have any of the three, whatever you've written here are the ones that will affect our allocation schedule, nothing else. Salary to partners, interest on capital, bonus, commission, less interest on drawings. Because interest on drawings is an expense to the partners, so it reduces their income.
Okay.
So you skip one line, then you talk about, you don't even skip one line. Here we need to ask ourselves, what is the share of profit or loss? Then we have the business income, taxable business income, ile tulikuwa nayo pale juu. So for the 8 months, business income yetu ni hii, right?
Yes.
So tuko kwa total, hii tunaweka kwa total. Cut letter hapa kwa total. For the 3 months, our business income is this. For the 4 months, sorry. So, so out of this amount, tunajiuliza, out of 2630, tunalipa salary ya 320, tunalipa interest on capital of 332.8. What is the balance? The balance that remains to share as profit. So this one equals to this minus this minus this. The balancing figure is the share of profit. Kani negative una share kama loss, kani positive una share kama profit. Sawa.
Okay. So unatoa hizo ziko hapo juu.
Yes. So you ask yourself, what should I add to this to get this total? So that becomes the balancing figure, which is now the profit that is to be shared to the respective partners as per their profit and loss sharing ratios. 8 months, how are they sharing? 3:2. Right?
Yeah.
So Henry is getting 3, Titus is getting 2, total is 5. So therefore for Henry, it will be 3/5 times this. Are we there?
Logo. Yes.
Kosawa?
Yes.
Then Titus will be 2/what? 2/5 of these, sindio? So the share of profit and loss. That is for the 3 months.
The 8 months.
For the 8 months, sorry. Can you have for the 4 months? 4 months, what was the new profit and loss sharing ratio?
3:1.
3:1 for Henry, Titus, and Stella. So therefore, Henry equals to 3. Is it over 6?
Yes.
Yeah, 3 plus 2 plus 1, that is 6. Titus is 2/6 times this. And Stella is 1, right? 1/6.
Yes.
Times this. I'll share this recording. Najua nimekimbia mbio. Lazima nimekuacha nyuma somewhere.
Hapana, nimekatch up bado.
Sawa, nice. So therefore, with that one, we add all these, and that becomes the taxable business income for Henry. We add that. That is for Titus for the 8 months. We add that, we get for Henry. We add, we get for Titus for 4 months. And we add, we get for Stella. Swali tumemaliza.
So, okay. Hapo hizo za taxable tunaweza weka another row hapo. Instead of business income ikuwe taxable income.
No, hiyo ni business income peke yake, so that kama uko na any other income unaoleta hapa juu sasa.
Okay.
So in our case there is no any other income. Hakuna other income. So therefore now we have our total taxable income, which will now be the total of these. Ni hivyo tu.
Okay. Kuna kakazi kidogo.
So that is, hapo ndo kuna kazi kidogo.
So total taxable income umesema?
So total taxable income is a business income plus other incomes.
Okay.
Yeah.
So if I kwa 0 inafaa kwa hiyo 1190.
Yes. What did I do here? Is the summation of B73.
Yeah.
Ndio hiyo. So for Henry, Titus, and Stella. I think that's fine.
Yeah, that's good. That's okay.
So tomorrow, hopefully by around 2, our sister never showed up, right?
Yeah, she has not showed up.
Sawa. I hope tuta communicate kwa group tuone kama anaweza join kesho.
Okay.
I just want us to focus on this sitting, tufanye maswali zake. So tomorrow the next question that is in this sitting is VAT. VAT we can hold a little bit. We'll do taxation of insurance company. Yeah. So tomorrow we shall do insurance. And maybe after insurance, you can look for another question of this tufanye.
Yeah, partnership.
Yeah, partnership. Yeah, incomplete records because it is very